Hello, I'm David Frazier with Investors Monitor, and this is our daily morning market prep show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to impact the value of your financial market portfolios. Well, today on Wednesday,
September the 9th, at around 8 o'clock a.m. Eastern Time, futures contracts on all of the major U.S. stock market indices were up fairly considerably. Specifically, futures contracts on the Dow were up approximately 180 points, on the S&P 500 up approximately 20 points, and on the NASDAQ Composite Index up approximately 50 points as of 8 o'clock a.m. Eastern Time. And what does that tell us? Well, of course, it tells us that U.S. stock prices in general, as measured by the major stock market indices, are likely to move higher again early today on Wednesday, September 9th. However, if you go and take a look at where the major U.S. stock market indices traded over the past couple of weeks, you'll find that if the S&P 500, Dow, and NASDAQ were to move up the way that futures contracts indicate, that they'll probably run into resistance levels probably within the first hour of trading, if not the first half hour of trading. Specifically, I'm showing that the Dow Jones Industrial Average has price resistance at around the 16,692 level, that the NASDAQ has resistance at around 4860, and the S&P 500 at around 1989. So if you were to add the change in the futures contracts to yesterday's closes on those major stock market indices, you'll find that they're probably going to move right up to those resistance levels, and but they're probably going to stop at those levels, and then will pull back during the remainder of the day. And the reason I say that is because, as I've said repeatedly over the past few days, we've had a large and increasing number of economic statistics, both here in the United States and from around the globe, indicate that the pace of economic growth in the United States, as well as in Japan, Europe, and China, is probably going to slow over the next few months. And we got just one more important economic statistic for the United States yesterday that is telling us the same thing. That statistic being household or individual credit, debt, the amount of debt that's taken on by Americans during any given month. And household debt declined last month and has been trending lower since August of last year. And some of you might think, well, that's a good thing if people are taking on more debt. And in a sense, it is a good thing. But it's also a bad thing in regard to where the economy's headed over the short term. And the reason being is as follows. Well, why would households tend to take on less and less debt during an economic expansion? Why would they do that? Well, they would do it for only one reason, and that is because they're not confident about the future direction of the economy. They're not as confident about their job security. They're not as confident about the incomes that they'll generate during the months ahead. And if that's the case, they take on less debt. And if they take on less debt, they spend less money. And household debt, or the change in household debt, I should say, has been a very reliable leading economic indicator for at least the past 50 years. So we have just one more leading economic indicator suggesting that the pace of economic growth here in the United States is going to slow over the next few months. And if we turn to economic developments abroad, we've got statistics out of Japan, Europe, and China
over the past couple of days that's telling us the same thing. For example, several leading economic indicators for Japan, as well as the Conference Board's index of leading economic indicators for Japan, deteriorated fairly considerably during the past month. And that's suggesting that the pace of economic growth is going to slow in Japan, or it's going to actually worsen because during the past 2 quarters, there was no economic growth in Japan. Japan's economy actually contracted during each of the past 2 quarters. So Japan's already in a mild recession, and economic statistics coming out of Japan suggest that Japan's going to remain in a recession for the quarter ending in September. In regard to Europe, we got statistics this morning showing that industrial production in Europe declined during July. And industrial production is actually a coincident economic indicator, meaning it's a statistic that reveals what's happening at the current time or very, very recently, as opposed to what's likely going to happen in the future. So in industrial production has always been a very reliable coincident economic indicator, meaning if industrial production declines, any given country in which we're speaking of industrial production, the pace of economic growth in that country is likely going to decline. And lastly, we got statistics from China over the past couple of days that showed that exports out of China declined sharply during July. So, I'm just keep telling you the same thing, and I keep telling you this because, once again, I'm not one of these perennial bears. I'm not always negative. I'm not a gloom and doomer. But when I go by the data, I don't read financial newspapers or magazines. I just look at the data, and I've been doing this for over 25 years, and I know what data to monitor closely. So even though these economic statistics that I just mentioned and that I've mentioned in the past and will continue to mention in the future might seem pretty boring to you, well, it shouldn't be, because the statistics that I talk about are statistics that are very, very, very important regarding giving us information on where economies are headed and where stock prices are likely headed approximately 3 to even up to 18 months in the future. So these are very, very important statistics. I think I'm going to leave it at that. Once again, we strive to tell you everything that you need to know, but nothing more. And there's really nothing more to talk about this morning. So if you're not watching this video on our internet website, I encourage you to go to our site at www.investorsmonitor.com. And the reason being is there's lots of statistics there you can look at for those of you that care to look at those statistics. If you don't care to look at them, I understand that, and I encourage you to instead sign up for our free weekly commentary. It doesn't cost you anything. All you need to do is put in your name and email address. You do not need to provide any credit card information. So that's all that I have to say for this morning. I hope you got something out of today's show, and we look forward to you tuning in again tomorrow on Thursday. Thank you.